Please welcome to the stage KKR co-presidents Joseph Bae and Scott Nuttall and Bloomberg executive editor Jason Kelly.
A smattering of applause for you.
We'll take
Now
it.
we got to wow them. Now we got to wow them. Well, guys, thank you for joining us to kick off this conference. Thanks to Peter and Eric for teeing it all up. We're going to go down memory lane in a few minutes, but I wanted to start in the present with state of deal making. Seller's market or a buyer's market right now? Scott, I'll start with you.
I'd say globally on the whole, it's a seller's market. I'd say we're late cycle in the U.S. in particular, and if you look at our activity, especially in the private equity side, we've been net sellers, especially in the U.S. and Europe.
Mm-hmm. And Joe, you're buying. So buying some, where are you buying?
Well, I think as Scott said, in this kind of market where we're late cycle, you got to be really disciplined on how you deploy capital. I think on average, we're probably more like $1.50 to $2 of exits for every dollar of investment in the past several years. Mm-hmm. So clearly trying to take advantage of this high valuation environment. In terms of where we're buying, I think some of the more compelling opportunities is really where there's complexity. Mm-hmm. That's really where you get the best values, where firms like ours, I think with the operational capabilities, can really bring more value to the table. Mm-hmm. So corporate carve-outs has been a big theme for us, whether that's in Japan or Korea, or the recent deal we did with Unilever for their spreads business. I think the other area we're spending a lot of time in terms of new investments is really using our existing portfolio companies as platforms for investment. So internet brands buying WebMD would be a good example of that.
And competition for deals, what's the state there? Who are the competitors and how fierce is it out there? Scott?
Well, I'd say the competition is significant. It's both financial buyers and strategic buyers. But to Joe's point, you've got to have an angle. You've got to have an advantage. We have used our existing portfolio companies in a number of situations and been able to act like a strategic buyer by investing more in companies we already control, so we can extract synergies and act like a strategic buyer. Or to Joe's point, we're really buying complexity and selling simplicity. So some of these large corporate carve-outs are incredibly complex. You've got to really stand up an entire new enterprise to be able to carve out a big segment of a large company. That takes a significant amount of resource. Mm-hmm. So you've got to be able to lean in where others are not. And the public markets today really like the simple stories. And so it's in this complexity that we've been able to find value.
Right. So one of the underlying themes, or overarching themes, I should say, of this conference this year is partnership. And we very notably wanted you guys to kick it off in part because you're relatively new in your current seats as co-presidents and co-chief operating officers. But I want to take you back to 1996. An analyst class, I believe, of two.
Correct.
Who were both sitting here on this couch. You show up at 9 West 57th Street expecting what? What do you see when you get to KKR 22 years ago?
Well, it's
other than you see this guy.
Well, I joined first, so I was already there.
This is he joined
September.
6 weeks, 8 weeks before me, so he calls himself the more senior of the two of us.
This is like when twins are born.
Exactly, there's a little bit of that going on. Look, I mean, the industry was small. It wasn't even referred to as an industry back then. So KKR, I don't know, we had 40 or 50 employees. To your point, we were the two analysts hired in New York in '96, and in those days, there'd be years we didn't hire anybody. And we were finishing investing our 1993 fund, which was $1.9 billion. Right. So we were a small firm focused entirely on private equity, just in the U.S. So quite a bit different than where we are today. Today we're 21 offices around the world. Then we were 2, and we've grown from 40 or 50 people to 1,200 around the world. So significant changes.
So why'd you join, Joe? What was the pitch?
My story in terms of coming to KKR is probably a little more complicated than Scott's. I was right about to start up at HBS. So I had moved up to Harvard. I was in the dorm, and I got a call from a headhunter 2 weeks literally before classes started. This was late summer. And a headhunter called me and said, KKR is looking to hire 1 or 2 analysts in New York this year. You'd be crazy not to go down and meet Henry Kravis. which is absolutely right. So I jumped in my car, drove down, spent the entire day in New York, met all the partners in New York, got on a plane and met George and my partners on the West Coast. And it was really about the people. I mean, they were doing obviously very interesting investments, but more than the deals, it was really more the people you met. It's a mentorship, an apprenticeship in private equity, and I thought it was the perfect place really to learn how to invest.
Do you guys like each other from the beginning, or were you skeptical?
I remember liking you from the beginning.
Yeah, you spend 20 hours with each other every day. You tend to like
Our
each other.
offices were right next to each other. You know, a deal would come in the firm. It was one of the two of us were working on it.
Right.
So we've been close friends from the beginning.
And so what was involved in being an analyst at KKR in 1990? Just whatever was coming at you?
Yeah, we were both, we were all generalists back in those days. There weren't enough of us. I think we had, 15 or so total on the investment team. So what was involved is an opportunity came in, who's less busy would be the one to take it on, and then take it all the way through, oftentimes through ownership, and then ultimately managing it as a portfolio company.
Right.
And we had less structure then. Like we have very structured investment committees now, portfolio management committees. But back in 1996, it was a small partnership. You were asked to look at a company over the weekend, and Monday you walk into Henry Kravis's office and you talk about the company, why you like it, why you don't like it. But that was really the learning environment back then.
Yeah, and in those days, the investment committee is you'd walk into Henry's office, call George, and that was your investment committee. It was a little bit different than it is now. But we've always been a small family firm. So Henry and George are first cousins. I say that Joe comes from the Korean branch of the Nuttall family. It's like we've all been together for a very long time.
Well, let's talk about that because that is something distinct. I think it is utterly unique about KKR in the sense that there is literally a blood relation between the two founders who are still there. How do you can't replicate that exactly without some very strange science. So how do you replicate the ethos of that between the two of you?
Well, I'd say, look, we've been together since we were 24 years old, Joe and I, in terms of working. Our families kind of have grown up together. And so we've spent most of our working lives kind of side by side, and both inside the office and outside. And it's going to be, before too long, we'll have been at the firm half our lives. So Henry and George have been together since they were 4. We've been together since we were 24. So you're right, you can't replicate it, but we've been through a lot together. And I'd say with the two of them as well. I mean, the 4 of us are able to work seamlessly together because we've been together over 2 decades.
Right.
I would say, personal chemistry, what Henry and George have role modeled for the firm over the last 42 years is really that effective leadership as partners together at the top. And I think Scott and I have very complementary skills, actually, in terms of how we invest, how we manage. But we've learned each other's styles over 22 years working together, and that's really what delivers the efficiency and the seamless leadership, I think.
All right, so break it down for us. How does it work day to day? There's always a question on Wall Street, it feels like, which sort of falls in and out of love with the idea of co's, right?
Yeah.
And some people say it'll never work, and some people say it always should work. So how does it work between you guys just day to day? How do you split it up?
Well, we decided to take a major minor approach. We have a lot of ground to cover. We manage nearly $200 billion for third parties. We've got a large balance sheet that we manage for the firm. So it was impossible and didn't make a lot of sense for us both to do everything all the time. So we've taken a major minor approach. There's a number of businesses that I major on and Joe's the minor, and vice versa. So that anybody in the firm, if they can get to one of us, they've in effect been able to get an answer. But that's how we've kind of broken down things. And the majors are things that we've historically both focused on or built, and the minor a bit less so. And it all has worked because we both worked across all different parts of the firm over time.
So Joe, your majors are?
So my majors are our global private equity business, our growth investing platforms, and real assets. So infrastructure, energy, and real estate. Scott?
So I've got corporate and real estate credit, our capital markets business, our capital raising activities, our balance sheet, and kind of corporate development and strategy.
Mm-hmm. And where we overlap is really on the internal functions. So legal compliance reports up to both of us, HR, finance, et cetera.
And so how does it work with the founders? What's the day-to-day with them? Because those guys are definitely around.
Well, the biggest change, I think, since this announcement was made last July, they used to have 5 direct reports. Scott and I being two of those. And today they have two direct reports,
Right.
with all the people now reporting up to us. But that's really the change. It's been evolutionary at our firm. It wasn't a one-time decision and there was a radical change in our organization. It was really simplifying from 5 people that reporting to Henry and George to the 2 of us.
Yeah, and to Joe's point, before the announcement last July, he and I together had probably 2/3 of the firm's activities already reporting into the 2 of us. So it's a change, but it's not a radical change.
Right.
And look, we're talking amongst the 4 of us all the time. Email gets used a lot, and every Monday afternoon we've got a standing 2-hour call to go through everything going on in the firm.
Right. I did, as a preview, I've got an interview coming later this week with George Roberts, who did mention to me as we were taping that with some glee that he likes saying to people, that's a great question. Why don't you ask Joe and Scott that question? So it seems like he takes advantage of this at that point, and Henry too, I would imagine.
Yes, it's working quite well.
Right. So let's go back to the state of the world if we can. Joe, you talked about some of the areas that you're focused on. We talked about private equity valuations a little bit. Some of the areas that you are overseeing probably could be considered more expansion of efforts. Real assets. Where are the opportunities there specifically, maybe in real assets and infrastructure, if you will?
Sure. I think the exciting part of KKR is we've been around for 42 years, but outside of our private equity business, many of our newer platforms have been around for 10 to 12 years. And real assets clearly falls into that category. Infrastructure is one of our most exciting areas, I think, for future growth. It's obviously an enormous asset class. It's underinvested globally in infrastructure, and it's where long-term patient capital can really make a difference. So we started that business a little over 10 years ago with $1 billion Fund 1. Fund 2 was $3 billion, and we're well on our way to a $6 to $7 billion Fund 3 at this point. So we're scaling these businesses to similar size, quite frankly, to some of the funds we have now in private equity. Same thing in real estate. We're a little bit earlier there in terms of the development of that business. We have a U.S. real estate equities business on Fund 2. We still have our first fund in Europe we're investing. We'll be starting our business in Asia in the coming 12 months for real estate. So still early days.
And state of real estate at this point, I mean, similar to what you guys were describing in terms of valuations with private equity, where are we in the commercial and residential real estate cycle?
Listen, I think you need to be very careful, again, at this point in the cycle. I think a lot of the big real estate deals you're hearing about are not opportunistic real estate. They're more core real estate or core plus. Our focus today in the marketplace on the equity side is really around opportunistic, more private equity style returns, real estate. And these are $1 billion to $2 billion funds, so they're not too big. We have the ability to be very, very opportunistic and disciplined. And real estate's so local, right? So it's hard to generalize by market or asset class, but it's really, doing the hard work to find that unique value.
And just staying with you for a second, infrastructure, I feel like we've been talking about for years. We've been talking about at higher volume for the last couple of years, given what's come from the U.S. government in terms of hopes and dreams about rebuilding U.S. infrastructure. How real is that, pun intended? And are there places where you feel like you're able to invest?
It really depends. Our infrastructure product is a global product. So we are actually probably more invested in Europe today than we are in the U.S. Europe is further along that curve around privatization of infrastructure assets, around public partnerships with private governments as well, and deregulation, like in the UK. So we've seen more activity coming out of Europe in the past 5 years in infrastructure than the US. In the US, I think a big focus is really around the midstream space. I think with the MLP market still on its back, there's a real gap in the market for capital for midstream assets. And that's really in the last 2 to 3 years where we've been leaning in quite aggressively.
So Scott, you have, one of your responsibilities for the past few years has been being involved in the IPO, talking to public investors. The public investor has not, shall we say, embraced private equity as a publicly traded asset class maybe as much as you would have hoped. Why is that?
Well, I think it's a few things. One, it's still relatively young as a space in the public markets. And so until 5, 6 years ago, there were only a few of us that were publicly traded, so it wasn't really a space. It's now emerging as one. And I think people are still getting up the curve as to what the business is and how it operates. So there's an education aspect to it. I think a second thing that is clear is the business models are a bit different. We make money sure for the fee aspect, which the market's used to in terms of traditional asset managers, but carried interest is a relatively new concept in the public markets. And I think the markets, to your point, have struggled with how to value it, how to assess it over the long term. What kind of multiple do you put on it? And that's been a big question. And so there's been a pretty low multiple put on that part of the earnings stream. And I think people are waiting, what will happen, when the markets pull back a bit, what happens to that carry line over time. But I think, from our standpoint, one of the biggest contributing factors is just the size of the buyer universe. Mm-hmm. So all of us came public as publicly traded partnerships, which means we issue a K-1, as a tax reporting matter. And that limits the buyer universe. So by our estimates, 60-70% of the buying universe cannot buy a publicly traded partnership.
Right.
So we tended to, as a result, focus on a pretty small group of investors with a relatively new story in the public markets. We announced recently that we're actually in the process of converting from a PTP to a C corporation for that reason, to expand the buyer universe.
Right.
So I think it's on us to continue to perform and tell our story. But our hope is that with this conversion, we'll find a broader audience.
And how big of a deal as someone who's been in private equity for a long time, Joe, how big of a deal did that feel like? I mean, to the average person, they're like, okay, like that sounds
conversion?
mildly interesting. But is it a big deal?
The conversion to the C Corp.
Yes.
No, listen, it's something we've been talking about for a really long time. Our goal as a company and for our employees is really to do everything we can to make sure we're as successful 10, 20 years down the road as we possibly can be. And having the right fundamental owners of our business, having the right corporate structure so that we could have more flexibility in terms of issuing stock, preferred securities, ways to finance our own business over time. C Corp has a lot of advantages in that way. So I think internally there was a tremendous amount of support to do that.
Do you guys expect that the rest of the industry will now follow?
I don't know. I think the firms are different. I think we tend to all get painted with a similar brush, but we are quite a bit different as
by journalists. We're very simple people. We need clear explanations of things.
But we as a firm have just a bit of a different business model again because we have our balance sheet,
right,
which is a big part of our institution. We have a capital markets business, which is a bit different. So we'll see. I think we'll see how these stocks perform over the long term. But to Joe's point, this isn't about where we trade in July or through the rest of this year even. Mm-hmm. It's about can we find a set of investors that are more aligned with our thought process around really long-term value creation and compounding.
So let me ask you about the fundraising on the private side, because
Sure.
that, as you mentioned, falls into your bucket as a major. What's the biggest worry on the minds of your institutional limited partners at this point?
Well, look, I think for the most part, the biggest focus is that a lot of them, especially in pension plan world, have a 7 or 8% return target. And if they look across the vast majority of what they've been investing in over the last 5 to 10 years, it has not been generating those kinds of returns. So the real question for them is how do they reach to get incremental return and hit their overall targets, but do so with being cognizant of the fact that we're late cycle, certainly in the US, maybe more mid-cycle in Europe, and not take risk at the wrong time. Mm-hmm. And so a lot of the discussion is around, well, how do I get that incremental return without regret? And that's really been the question.
Return without regret.
Exactly.
The story of private equity.
Exactly.
Right?
And so, what we're seeing everywhere is, a lot of folks are increasing their allocation to alternatives because that has generated more than the target. And then it's a question of, well, how do you leg into it? And the definition of alternatives has continued to expand.
Yeah. There's also an element of there's been so much return of capital in our industry, as many people have been leaning into these valuations to exit. So there's this reinvestment concern that many pension funds have and sovereigns have. They're getting more capital back than they're deploying in many cases in the alternative space.
I'd say another big theme and focus is they want to do more with fewer firms.
Right.
I think what we had probably 10, 15 years ago was a diversification. So there was some plans that were invested in 200 different, GPs. Mm-hmm. And now what they're saying is, okay, I've now bought the index inadvertently. And in alternatives and private equity in particular, you want to be top quartile. And so now what we're seeing is more of a focus. They're trying to do more investing with fewer players, which means broader and larger mandates.
And how much leverage does that give them on fee negotiations with you guys? How are you seeing fees trend?
Well, we've had a big effort around what we're calling strategic partnerships, where we're very happy if someone's prepared to give us large-scale capital, $3, $4, $5 billion over a long period of time with recycling. We're very happy to talk to them about discounted economics, because for us, having that line of sight for 20 to 30 years, which is the duration of some of these long-term partnerships, is significant, and it funds a number of our different businesses. So I'd say if it's just size, there's a little bit of discussion around economics, but it's really duration and breadth.
Joe, we haven't talked at all yet about Asia. We mentioned the U.S., we've mentioned Europe a bit. You've spent a lot of time there. That was your most recent assignment before here was running that. Where does Asia stand in kind of the KKR mindset at this point in terms of opportunity and that sort of buying-selling balance?
Sure, I think it's a little more balanced in Asia in terms of buying and selling. It's probably 1-for-1 in terms of deployment versus monetization. And it's hard to generalize about Asia given it's a massive geography with a lot of different dynamics going on. But if you take a big step back, it is probably the fastest growing part of our private equity business today in terms of AUM, in terms of deal activity, and in terms of our own organizational build. We have 8 offices now in Asia, and we're the largest private equity investor in the region today. Some of the really compelling trends, I think, people always talk about, the really exciting growth in China, India, Indonesia, some of the big domestic emerging economies, which we absolutely are excited about. But some of the less understood opportunities, I think, are really perhaps in North Asia, in Korea and Japan, probably among the cheapest valuations among mature economies today, massive conglomerates and family groups that are shedding non-core assets for the first time. And in our business, the ability to really drive fundamental operational improvement, margin improvement in these companies because they're non-core subsidiaries of large parent companies. So Japan for us is one of our top priorities globally in terms of the buyout market, where we're seeing cheaper valuations, lower cost funding, financing for deals, a lot less competition than in Western markets, and quite frankly, much more significant operational improvement potential in the businesses that we're buying.
One thing I wanted to make sure we talked about before we run out of time is you've got a couple different avenues that you can pursue within KKR to understand global economics and maybe just as important, global politics. So Henry McVeigh, giving you sort of the macroeconomic and in cases, microeconomic perspective, as well as David Petraeus, who can give you probably as good a read as anyone on, shall we say, hotspots around the world. Geopolitics. What are you hearing from them as all of us read headlines every day about what's going on in the world, and how is it affecting the way you deploy capital?
Well, let me take McVeigh, and you can talk about geopolitics a bit. I'd say in terms of what Henry McVeigh's group does, it helps us, in the first instance, make sure we're reading the signals that we're getting. So we have a large portfolio around the world. I'd say before Henry and the team got there, we did an okay job using the data, but we do a much better job now translating the information we get out of our portfolio companies into kind of forward-looking metrics as to where the world's going.
So what's an insight that you've gleaned from him of late?
Well, I'd say one of the things that the team has built is kind of these GDP predictor models, which have turned out, kind of back testing, have been quite accurate because we have a lot of good data that we're able to kind of feed into a model that tells us where we think the world's going. And for example, we've been able to back test that and test as to when we expect a recession to happen in the United States.
And that is?
Not the next 12 months, but sometime in the next 24, the readings start to get that, we're going to see something. Now our expectation, it's more of a modest pullback than what we saw last go around. So maybe more like a 2001 type feel to it as opposed to the financial crisis. But it does tell us things like that as to when we expect that maybe we're going to see a bit of a dip in the U.S. economy, and we're able to use that around the world. That would be one example.
Right. Geopolitics, Joe?
I think with both David Petraeus and Henry McVeigh to a certain degree, it's also around issues like trade, which is obviously in the press every day now. And I think Henry's been, and David have been incredibly helpful in really guiding our teams at a high level to say, avoid areas where you're dependent on global trade for growth. So, we're leaning into big domestic economies, domestic populations, big domestic consumption stories. whether that's Mexico, whether that's Indonesia, China, India, versus companies that are highly dependent on global trade for growth. And that's an insight that both have really brought to the table in different ways, with our strategic trading partners in Asia, but also in some of the more, I would say, frontier markets for us. David Petraeus in particular, we invested in a cable company in Serbia several years back. We had never invested in Serbia before. And really getting comfortable with the politics, the governance in that country, the political risk in that country was a critical part of getting us comfortable making that first move in that country.
So a far cry from 1996 for you boys.
Far cry.
Right.
Yeah.
Thanks so much for helping us kick it off.
Thanks for having
Scott
us.
Nuttall, Joe Bae. Thank you.
Thank you.